All right, hey everybody. We just heard on Friday that Moody's has essentially stripped the U.S. credit rating. It was the last AAA credit rating the U.S. had. I think Fitch, I believe, stripped it in 2023. So yeah, anyway, so basically what that means is that there's less confidence in the sort of U.S. government to be able to sort of pay its obligations, its bonds back. That's basically what that means. It's not necessarily realistic for a default to happen, but the rating agencies, they that's their job, is to kind of give investors an outlook of how pristine, or lack thereof, pristine is a company's, or in this case a country's, credit worthiness is. Now, of course, the question is, what does that mean? First of all, let's understand, how markets have reacted. So I'm going to see if I can quickly share this with you. This is the initial reaction, and by the time you watch this, who knows when that is. But this is the S&P 500. Hopefully, you guys can see this. This was the Friday's trading action. This is our TST trend and momentum indicator. If you don't have it, you need it. You really do. Buy signal, profit target. Then we received, right after the market closed, we received that news, and we received a sell signal immediately, and the S&P dropped about 1%. I'm recording this here Sunday, so by the time you watch this, who knows what it is. But the point is, that's the initial reaction of the equity market. It might be an absolute nothing burger, which is why we need to watch the long end of the bond market. And so that gets me to the second chart I want to quickly show you, which is really what we need to watch. And this is way more important than really anything else. And so this is the bond market, the 10-year yield. I'm going to zoom in here in just a second. Let me show you. So this here is really what we need to watch. This is the 30-year bond yield. And we're more or less at 5%. And we'll see what this does. If we were to be able to break above there and stay above there for a while, we'll see what that does to the equity market. Because until that happens, and it's likely that will happen, right? But I think until that happens, the equity market is not going to care too much. If you haven't noticed it yet, the equity market, of course, has essentially reversed sharply back up. The S&P and NASDAQ are now just positive for the year after being down materially. So long story short, I can't give you a definite answer. It certainly is concerning. Everyone knows that we need to get that debt down, but the 30-year bond yield, how it reacts, is going to tell us a lot about how equities like this or not.